Investors and savers are always facing a difficult set of choices. Where is the best place to put your wealth? It's a very complicated problem, and the factors that go into making the decision can be maddening. For each person, the right answer can be different, mainly because each person will have a different set of objectives. Speculators are generally willing to take very large risks to make outsized gains in wealth, and they'll move their choice of assets from one to another very frequently in order to take advantage of temporary advantages of certain assets. Investors are willing to take on some risk and make their funds somewhat illiquid, provided that the potential of a reliable increase in wealth is present. The saver is mainly interested in taking very little risk and watching wealth grow as additional funds are added to a rock-steady investment. But what of our current environment, where the boundaries of speculation, investment, and saving are hopelessly blurred? Sure, our saver can invest in T-bills or savings bonds, but our saver cannot be guaranteed that his or her wealth will have a consistently growing purchasing power. Quite the opposite. History has shown that T-bills can be a disastrous place to store wealth if they are purchased at the wrong time. So our saver faces a problem of how to preserve purchasing power over time. Gold and silver, as well as other precious metals, can be good places to store wealth for the long term, but even these historically reliable stores of value can lose significant purchasing power if bought at the wrong time. So what is our saver to do? Well, I've introduced a number of videos on this subject over the past year where I've discussed relative valuations and how to know if the metals are fairly priced, expensive, or cheap. Today I'm going to introduce you to a way for the saver to decide at any point in time if his or her best bet for a 5 to 10 year time horizon is gold, silver, or short-term bonds. Why am I focusing on these three assets? Well, it's partly because these three are what I consider to be the three principal monetary assets of the world. But it's also because I will show you, if you're choosing the correct one, it can lead to substantial opportunities to build wealth. So with that said, let's get into the meat of the presentation. Let's take a look at historic price changes in the dollar relative to gold. What I'm showing here is 45 years worth of data. The dots represent a rate of return of cash relative to gold. I know, most of you are used to looking at the price change of gold in terms of dollars, but I prefer to look at it the other way around because I view gold as the superior money. I see the value of the dollar changing relative to gold, and not the other way around. Measuring gold in terms of the dollar is a little bit like assuming that the sun revolves around the earth. So with that said, how do we interpret each green dot? Well, what it tells you is how quickly the dollar is increasing or decreasing in value relative to gold. We'll talk about interest rates in a minute. For now, we'll just be discussing cash under the mattress. So if you hold on to plain cash for a 5-year period, and the green dot is located at -10, then what that means is that the rate at which the dollar is losing value relative to gold is 10% per year over a 5-year holding period. The opposite would be true if the dot was located at +10. In this case, the dollar would be appreciating in value relative to gold at a rate of 10% per year over a 5-year holding period. I've chosen to use 5-year windows of time because any shorter than that and the returns are just noise. They're very difficult, if not impossible, to predict. What we're looking to do is to develop a tool with at least some predictive power to put the odds in our favor and reduce risk. 5 years is about right for this purpose. I've plotted our returns versus the gold to oil ratio. This is a ratio that I've discussed in the past as a metric for valuing gold. As you can see by the graph, there is in fact a correlation between the two. It's not a perfect correlation, but it provides us with some information that can be very helpful to us in determining whether or not the idea of holding some dollar-based assets has any merit for the saver. I fitted a curve to this data. Note that the curve is nonlinear. I will spare you the details, but this is really the best curve that I've found to date to explain the trend in the historical data. I've placed some statistics down below just to illustrate that the curve is statistically meaningful. The correlation coefficient, or R-squared metric, is close to 50%. For you non-statisticians out there, this just means that the model explains about 50% of the variation in the data. The other 50% of the variation is due to other factors, including speculation and noise. So while the correlation is far from perfect, from the standpoint of a financial risk model, it is actually pretty good. It can provide our saver with a very useful advantage in figuring out if gold or short-term bonds are a better value. And I'll show you on the next slide just how true this is. We must also ask about statistical significance. Many people point to a high correlation coefficient as a reason to believe a model, but it's not enough. After all, a person can take only 2 data points, fit a straight line to the data, and have a correlation coefficient of 100%, but might find later that the correlation found was actually due to noise and not due to actual useful information contained in the data. So I've calculated what's called an F statistic here for the data as well. The F value of the correlation is 223. In order for the correlation to be 99% statistically significant, the F value would have had to be 4.65. So we can say that the curve is more than 99% statistically significant. And that's more than good enough for me. Okay, so what does this mean for you, the saver? Let's plot the data a different way. Let's go back 45 years and take a look at 5-year forward returns of T-bills in terms of gold. Note that I've added the effective interest rates now. It's a fairly straightforward thing to do. So we can see from the curve of actual results when T-bills have done much better than gold and when they have done much worse. For example, in the period of the 1970s up through the end of 1978, there was not a single time when a person could have bought T-bills, held them for 5 years, and had more wealth at the end of the period than if he or she had just bought gold. There was a time in March of 1974 when the T-bill saver could have done a little bit better over a 5-year holding period, but the advantage was practically meaningless. We can see from the chart also that starting in 1978 there was a period of time 20 years long that ended in 1998 when our saver would have done substantially better holding T-bills than holding gold. Then, of course, as we all know, following that period, there have been no 5-year periods since when buying T-bills instead of gold had worked out well. Now, this is not to say that there won't be short-term periods of time when the results won't be completely different. But since predicting these moves is so hard to do, we'll just focus on the longer-term picture. Now, take a look at the green curve. This is our model prediction from the previous slide based upon the gold-to-oil ratio at the time, and adding to it the interest rate available on T-bills. It would have predicted ahead of time how T-bills would perform relative to gold fairly well. You can see that the general trend is fairly well followed. Sure, there were periods of mismatch, but as far as predictive financial models are concerned, this is one of the better ones that I've seen. What's most remarkable for our purposes is that if we take the absolute magnitude of the relative return out of the picture and just focus on the question of whether T-bills will do better than gold or worse than gold, our model is remarkably predictive. It would have kept us largely out of T-bills in the 70s, largely in T-bills in the 80s and 90s, and again out of T-bills from the year 2000 forward. Okay, so this basically illustrates how we can objectively evaluate the relative merits of T-bills compared to gold. What about our other primary money, silver? Here is a similar plot of silver relative to gold for 10-year holding periods. Why did I choose 10 years? Well, it's because I found that anything less resulted in changes in valuation that were very difficult to predict. A 10-year holding period appears to be sufficient enough to determine ahead of time with reasonable confidence whether gold or silver is a better holding. So in this case, I'm plotting the relative returns against the gold to silver ratio. The data appears to have some curve in it, but there is no statistical evidence of curvature, so I'm just going to fit a straight line to the data. And a straight line fits fairly well. The correlation coefficient is about 70%, which means that about 70% of the variation in returns can be explained by the model. The other 30% is due to other factors. And this is fairly remarkable in terms of correlation. What's more, the F statistic is 100 times what would be required for a 99% statistical significance of the correlation. This is a very, very good model. Let's take a look at what it means in practical terms for our saver. Here, I'm plotting forward 10-year returns of silver at various points in time over the past 45 years. We can see that until 1987, there was no point in time when silver would have been a better long-term holding than gold. Sure, there were short bursts of time when silver was spectacularly better. Of course, there were also short periods of time when it was spectacularly worse. But those short-term gains and losses are very hard to predict ahead of time. The data also shows that from 1987 through 2004, it was generally better to buy silver and hold it for 10 years than it was to buy gold and hold for 10 years. Our model, shown in green, follows the trend fairly well. Not only does it accurately reflect which times favor which metal, but it also predicts the magnitude of the relative return fairly well. We don't have a 10-year forward return from 2004 onward for obvious reasons, but we can make one observation about how well the model predicts. We can see that the model predicted in early 2011 that silver would be a fairly poor savings vehicle relative to gold. And this is personally when I sold most of my silver. It turns out to have been the right decision so far. Of course, we'll have to wait until 2021 to know if it was the right decision for a 10-year holding period. Just the same, silver now appears to be on par with gold, and so I'm starting to accumulate some silver again. So where do we stand now? Well, let me introduce you to another way to visualize the relative merits of various options of savings vehicles. In the upper left-hand quadrant, I'm introducing to you a new chart that I haven't shown you before. It shows on the vertical axis the expected long-term rate of appreciation of treasury bills and savings bonds relative to gold. On the horizontal axis is the expected long-term rate of return of silver relative to gold. And the dot is the actual expectation. It's what we expect to happen. It is currently showing an expected 10.6% annual rate of depreciation of short-term bonds relative to gold, and an expected rate of return on silver that is on par with gold. I've placed an oval on this graph indicating the uncertainty in the prediction. The oval encompasses a distance that is one standard deviation away from the prediction. This is a reflection of possible error in model prediction. The actual outcome can be expected to fall within this oval roughly 68% of the time. And I won't explain why here, you'll just have to take my word for it. The chart in the upper right just shows where interest rates are currently relative to what they would need to be at various gold to oil ratios in order for bonds to be attractive. At the current gold to oil ratio, short-term paper would need to yield a little bit over 10% in order to justify holding short-term bonds. The bottom two charts are just a comparison of how the various metals compare against each other in terms of valuation. You've seen these charts before. Right now, platinum appears to be the superior choice, and palladium appears to be an inferior choice as a long-term holding. But I have to add a word of warning that I don't have as much historical data for platinum and palladium as I do for gold and silver. Thus, I'm not as confident about these two metals and what's going to happen in the future. On this page, you have what I consider to be all of the information that you really need to make a good long-term decision in terms of how to allocate your savings. If done properly, you can move your savings around to take advantage of swings in valuation. Doing so will result in not only preserving your wealth, but in building your wealth substantially. I've had very good success over the past decade and a half, and I hope you share in this success going forward. Just bear in mind that these relationships will not tell you what's going to happen tomorrow, next week, or even next year. They are, however, going to give you a fairly reliable indication of which asset will give you the best odds of doing well over the medium to long term. So please feel free to ask questions in the comments section of this video. I'm here to guide you, and I will provide you with whatever help I can whenever I'm able. And I will present to you updated charts over time, generally when the conditions warrant it.